So price, after it's moved away from structure, which it has here, I will now move my initial stop loss to break even. So the trade risk now is zero, which means I can now afford to take a scale in, which would be here. Because why?
All right, folks, here we are in Trading Up. We've got Ibby in the house from Falcon FX. We've just done, I've got to say, it is one of the top podcast interviews I've had on the show, especially from a mindset point of view. Go and look at it, the link below the video to go and check that out. It was truly awesome, and thank you very much for sharing that. But now what we're going to do is jump into a price chart and have a look at 3 trades on the UK 100 that you took, and how you do it. I mean, guess how you do it. So welcome back to the show.
Brilliant. Awesome. Let's go.
Our sponsor, Blue Guardian, is the only prop firm that gives their traders a tool to protect them from hitting their max daily loss and overtrading. It's super simple to use. Just set the Guardian Protector each day from your dashboard. Did you also know that they've just released an unlimited time evaluation with a 0 trading days requirement, giving you plenty of time to hit their low 8 and 4% targets, making it super fast to get funded. Plus, it's cheaper than the 40-day time limit evaluation. Check out the link and coupon in the description to get 10% off your next Blue Guardian evaluation.
Right. So these trades happened in the month of August. So this was last month now. Now, simple way we're looking at it. Obviously, these are the timeframes that we use. Don't touch the monthlies. Weeklies and dailies are a macro outlook. These are our intraday timeframes. And then the entry timeframes are 1 hour, 15, and 5. 5 is rarely used. It was used in this scenario, but it's only used in certain points and positions, which I'll explain now. So if we map it out, we have got these highs, as we can see here, at 7900s. Price tapped in. Now, how are we observing it here? Because it's a language, essentially, reading the markets. Like learning any language, you're not going to start off by writing a book in it. You're going to learn the words, the letters, you're going to piece things up. You'll notice that certain things piece up to mean certain things. So we look at something called price nature, which is essentially how did price respond to a set given area in the market? Did it respond with momentum, or did it respond with a lack of momentum? So price obviously broke out here. Naturally, what we call getting people caught on the wrong side. Price broke back in. And this is the model that it follows: 1, 2, and 3. Simple. Impulse, correction, and impulse. What happens in phase 2 here determines what's likely to happen in phase 3. It's as simple as we look at it. And there's a certain set behavioral pattern that will initiate itself here. Based on how it forms, will determine the third leg, of course. So we can see, and this is how price essentially generates volume. It's either going to find volume at a set given area. If there's limit orders there, whatever it might be, we don't really look at the mechanics behind that. It's unnecessary. Or it's going to build volume by consolidating for a set period of time. And it did there. Now look at the momentum that came from that. I'm observing that it broke one structure point and it tapped into the next on the left. You can see movement 1, movement 2, movement 3, same model. Movement 1, movement 2, movement 3, same model again. Now look what happened here. Price came in, swung up. So clearly there's momentum there, or something there. Someone clicked buy, as I like to say, or some entity clicked buy where they had power to move the market. Price came in again, it reacted the same way. Look where it came. If I remove these highs now, because we know where we're at, look where it came back into, within this range again. Same range. Look at the response. Move down, set pattern forms, continuation, move down, set pattern forms, continuation, move down, pull back, and again, it filled this area here in the wick. Now, for anybody listening, we don't look at zones, we look at price extremes, which is essentially the ray lines, the outer edge, pinpoint highs or lows. There's a reason we don't trade zones. Naturally, the way we trade is predicated around room for error. And if there's more room for error within a set zone, we've got more chances of trying to chase where that next trade is. We're not going to take it. So let's go down to the 4 hour where you'll see this. So what's actually happened is on the left here, you can see very simple continuation structure form there. This is a trade I also capitalized on, which won't break down here, but I will put it on my Instagram somewhere. So there was a trade within this. And you always have, probabilistically, you'll find 3 drives, particularly that happen in the market: 1, 2, and 3. You also have within that 1, 2, and 3, which make up a pattern. Now from here, I'm not going to be taking entries from there. Instead, price pushed down on the lower time frames, which I won't show now, but there was a beautiful continuation structure, very similar to how this looks, but very small, that happened here. And I got involved there, got out for about 8% on that trade. Anyway, my point. Now we're in the 1 hour. Look what happened here. If we look at this point, price sold off pretty heavy. Same sort of thing. Someone must have some selling power there. Price came in with a drive and it formed a set pattern that resembles the same behavior. Same behavior that, as you can see, happened here when it came into a value area on the left. Same pattern. Anyway, price came in and then it sold off. So instead of me trying to catch the perfect area per se, I let the market show me where the momentum is. So it's shown me it sold off. All right, cool. Now I'm looking for, after phase one has completed within this 1, 2, 3 sequence, phase two. What is happening within phase two? Now we have a continuation pattern form again. So if I isolate that for you, you've got this. Just above it, we've got a liquidity point, as you can see there. Why is that a liquidity point? The reason it's a liquidity point is because price came in, formed structure, broke up, and broke that with momentum, as you can see. So it's left a footprint, essentially. And if that's sat right above, and this is where I mentioned before in the podcast camp, that you can't look at one scenario and it be the same. For example, you could have this same pattern form like this, and you could have one form like this. This is above it. There's nothing above it there. So the chances of you getting tagged in and out for a loss here, if you take the entry, is higher in this scenario than you taking an entry there when there's not that there. Because price will naturally gravitate like a magnet towards that liquidity area. So now the risk on the setup, as I mentioned in the podcast, this would be a high risk trade. This would be a low risk trade. Yeah. Right. So now it's starting to piece together now.
Yeah, exactly.
So instead we would take what we like to call a coin and insurance entry, which is waiting for price to come back in, letting it do its thing. And if it does form a continuation pattern within that, we'll go to a lower time frame. And that's our insurance play. That's a safer option to play. That would now be a low risk entry. Anyway, so going into this on the left here, we can see price tapped in, broke past this area. And here is the actual key point that I want to reference. If you go to the 15-minute, we can see after this, let me just draw this on. You've got that. Inside of it, you've got 1, 2, 3. Same patterns are prevalent everywhere. And now here is the actual entry. So if I add on the top and bottom of structure, go to the 5-minute, which is the very rare scenario you will use it. The entry, as I mentioned before, retrace candle or pin bar. We've got a retrace candle here and it's met exactly. I'm very, very particular with this. It's closed at the edge. So I'll enter there. And then as you can see, stops wise, we don't normally in the 5-minute have a rule not to go lower than 10 pips because we want to have some breathing room. But there's certain scenarios where it's okay to do that because you're protected and the spreads won't be high, for example. So I could go to about, call it an 8-pip stop. I still want to give it some breathing room. And our model with scaling in is very simple. We want our max risk exposure to be fixed at any given time. So if we have 1% risk and that's our max exposure per position, I'm never going to look to exceed that. I don't agree when people say, oh, risk on a position, whatever you feel like. For example, if you know this is a high probability position, risk more. It messes with the numbers. And Mark's trained us not to do that. So price, after it's moved away from structure, which it has here, I will now move my initial stop loss to break even. So the trade risk now is 0, which means I can now afford to take a scale in, which would be here. Because why? You've had 1, 2, 3. Same exact thing again. This is where I say it gets a bit particular now. You have what you call 2 touches in terms of continuations, and you have 3 touch ones. 3 touch ones are much higher probability. This is a 2 touch. Now there's a chance of this becoming a 3 touch, like so, which we have to take into consideration. But the chances of it doing that after it's given you a deliberate answer here, because it's formed the continuation, is much less likely. When we study these patterns, we find that it's very unlikely that price is going to come down, form a deliberate continuation pattern, tag you in, and then just form that. It's a very small intricate detail, but that's what we spied. So I can afford to take that risk. I'll set my entry in the break of that, like so. This would be a stop order, as we can see. And then I can set my stops here by about 7 pips, being a bit more lenient. So I'm just literally trailing my stops now. So price is coming down here. I'm actually managing on the 1 hour, I forgot to mention. So our management time frame is only the 1 hour time frame. We don't manage in the 15. We don't manage in the 5-minute, always on the 1 hour time frame. And it's based off of previous structure. So what will happen is as price is pushed away around here, I'll break even this trade, which will mean that I move my initial trade stops to that same level. As it's breaking lower, so it now starts to break this structure, I can lock in more aggressively. Say price is down here, I'll usually be trailing it behind. This stop would be following it. So I'd have locked in about 5.5, 4%, about 9% and a bit. And there's one more now, again, similar pattern that forms here. Now I can afford to scale into that because I've got profit locked in here. So from a financial point, it's sensible. So if I go here, I can mark on at the first structure point, and that like so. You can see a little bit clearer on the 5 minute, 0.1, 0.2, 0.3. How do I know that's 0.1? Like that. It's giving me that example there, that clue. Now, because I'm further down into the run, and obviously naturally the further down you go into a run, naturally the bigger the corrections are going to be. The way I like to make it into analogy is that if a marathon runner is getting from point A to point B, he can't get there in one short breath. His breaths are naturally, as he's getting more tired, going to get bigger and bigger. That's what we look for. So the same thing is happening here, where as we're going further down, the probabilities of the pattern playing out, it needs more weight around the entry. So to give it more weight, instead of me using the 5 minute here now, to keep the risk level low, I'm going to use the 15-minute time frame, the higher time frame example to the 5. So I'll set my entry, same, retrace, as we can see there, engulfing candle. Stops above for about 13 pips, management on the 1 hour time frame. And when it gets to around down here, say I'd lock in about 1.5 when it's around here. And my stops for the previous trades move there as well. I've got, say, 9.6 on the first, 9 on the second, 1.5 on the third. And the market's taken me out for, I think, just under 20% there. Simple positions. Now, not every single trade is like that, but most trades would end up like 1.5, 2%, 3%. It could be 9% position like that. Could be a 15% position. I just take what the market gives me. I don't put a judgment on it.
Folks, Black Bull Markets have 10 merch packs to give away to clients who sign up before the end of the year, including one of these trader keys. So to go in the draw, all you need to do is sign up with the link below this video or in the podcast description, and you'll go in the draw to win. It's that simple. And remember, folks, when you sign up to Black Bull Markets through the Trading Nut link below, you're going to get a 100% deposit bonus up to $1,000 on your first deposit. All you need to do is click the link in the description below the video or the podcast. And how, I've got a couple of questions here. How
Sure.
long does it take somebody to, because there's a lot of knowledge in here, right? A lot of knowledge and experience. And I mean, for the novice traders, probably going to be kind of overwhelmed. I mean, how long would it take somebody to get, say, for example, advanced knowledge or experience to where you're at of recognizing these patterns and not sort of, and even anticipating them? Because I think that's the key, is anticipating when a pattern is formed and the setup is actually happening.
So, good question. So you have two particular points here. You've got the education and you've got the experience. Now, if, let's say, for example, you can tell I love my analogies. You've probably got that about me by now.
Yeah, great analogies, by the way.
If you've got north, which is where you want to go, and that's where you want to be as a trader, it doesn't matter how far you sail west or how fast you sail west, you're going the wrong way. So they've got the education as traders coming into Falcon, the tools that teach them how to essentially read the language that we speak. Now, on top of that is the experience that they gain. If they take those tools and they incorrectly apply them, which they shouldn't do, because we've got webinars every single week, we've got ongoing content, it's ongoing mentorship, it's not fixed content. There's a very unlikely chance that they're going to go in the wrong direction. But let's say they do. Are they now going to have 3 years of experience learning and trading the wrong way? But if they have got the tools, which they have, and they understand the basic mechanics of how we trade, how to spot a pattern, where it's best positioned to take a pattern, simple thing like I explained, like if we're all the way down here, me taking something this small is very high risk. Whereas this same pattern positioned, as you can see, literally right there higher up, has a much higher chance of playing out. And we explain those mechanics. Now, they now have to apply that over a period of time, call it 12 months, 16 months, 24 months, of going through different market conditions, different market cycles, independently assessing each trade scenario. And as you know, a poor worksman always blames their tools. They've got the tools. They just have to see, how can I effectively use this in each scenario? They assess that every week. And it's like that they're climbing a staircase and going up and up and up. So the simple blueprint camp that we give them is, in your first few months, learn the foundational elements, which we're revamping now as well, making them even better. Learn them, learn the language, learn the basics. After 3 months, then build a trade journal only after you've built your trade plan. Because why would you want to journal trades that don't fit a criteria? It doesn't make sense. What are you assessing? You're assessing trades that you don't even know if they're effective or not. So once you've got a trade plan, which we give them a blueprint for as to how to build, or they can even use a trading plan base, then based off of that, they then journal them trades. Then we teach them essentially within a certain structure how to trade them live, how they should be assessing those trades every week, what they should be assessing, how they build a plan of action to fix that. So they're actually having structured learning going forward. There is one-to-one coaching available as well, but they've got that. So within about, if they really focus, it all depends on the student. I would say within 12 months, they've got all the relevant knowledge they need to be able to be profitable. The only thing remaining is now market experience and also situational tweaks, like really specific niche scenario information that just comes with experience, really. And that's right.
Brilliant. Well, look, thank you, Ibby, for coming on the show, mate. This has been fantastic. Not just a fantastic chart breakdown, but also the interview as well. So, guys, before we wrap up, what's the best way for traders to get hold of you?
Instagram, definitely. So it's the same as my name. You got Ibby Ansari. It should be linked down below, but yeah, that's my best method of communication.
Yeah, as he mentioned, folks, go and check it out. There's a link under this video here to all the links and the podcast we did with Ibby. Also, whilst you're there, click subscribe, like, and that notifications bell, and we'll see you in the next video. Tired of missing trades or spending hours at the charts? Introducing my Robot Builders Club. With our platform, you can build bots in minutes, not weeks, without any coding required. Get lifetime access to my video course, VIP community, and over 40 ready-made robots. Works with MT4 or MT5, and as a bonus, you'll get 3 months access to my robot lab, where we build and test bots on live calls every week. Join the hundreds of traders who are trading smarter, not harder. Click the link in the description to learn more, get the free training, and download a free robot.